Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
This episode is brought to you by Latin Excellence. Visit latinexcellence.com. That's Latinx, CELLENCE.com or latinxmovement.com to learn more and shop our merchandise. You are excellence. Hello and welcome to another episode of On My Way to Wealth. My name is Luis and I'm your host. Thank you all for tuning in. Took a little break during the summer, but now we are back with fresh new content and episodes. Today, I want to talk to you about a Dependent Care FSA, which is a flexible spending account. It's a very common benefit for employers to offer these to their employees. And I just want to make sure that if you are eligible for this, that you're taking full advantage of it. You know, I'm always happy to share any opportunities for you to lower your taxable income and get as many dollars in your pocket as possible, right? So whenever there's anything that you can take advantage of, I'm going to be on the lookout for it so that I can share it with you. So let's talk about it briefly. I want to tell you what a Dependent Care FSA is, how it works, who's eligible for it, and all the benefits of it, how you can use it, right? So let's talk about it real quick. What is a Dependent Care FSA? So a Dependent Care FSA, you might be familiar with the word FSA for flexible spending account when it comes to your healthcare expenses. A lot of employers offer the FSA where you're able to put money pre-tax into this account that you can then use for like co-pays and things like that, right? So it's the same concept, except that it's for dependent care. And notice that I'm saying dependent because it doesn't necessarily mean child, so we're going to talk a lot about this a little later. But in essence, you can use it for anyone that is a dependent of yours, like an elderly person, somebody who's disabled, for example, and so on. So let's talk about it. Dependent Care FSA, designed for you to take this tax advantage account to reimburse yourself for out-of-pocket dependent care expenses. This way, you can fund the account with pre-tax dollars. So you open it with your employer. Typically, during open enrollment, you're going to see if your employer offers this is an option. So if you have children, for example, that you're going to be paying for a nanny, babysitter, while you're at work, things like that, this might make sense for you because you get to put in money pre-tax and then reimburse yourself for it, which is a great benefit. So this is not like FSAs because, if you've ever had an FSA, it's usually pre-funded by the employer, whether you actually get all the money up front. This is actually money that you have to put in yourself, and you can only use the amount of money that you put in yourself. So this is a key differentiator there. And one thing to keep in mind is that you have to be working, so let's say in the case of a couple, let's say husband and wife, for example, it can't be that one of you isn't working and you're staying at home and then you use that to pay for a nanny, like for date night or something like that. It's not going to work. It has to be while you're both at work. There are some exceptions. So like if one person in the marriage is not working, but they're like full-time student or something like that, or actively pursuing work, that's okay, right? So you can use the FSA for those purposes. Now, if you're married, you're generally only allowed to use one Dependent Care FSA. So it's possible that both spouses might have an option at work. So it's fine. Either one of you can use it, but it's usually only limited to one because there's a dollar limit amount of it as well, which is $5,000 for a married couple that you can use during the year. So this account is only available to pay for expenses of a dependent under the age of 13, if it's a child, right? A spouse or an adult dependent who is unable to take care of themselves, right? So something to keep in mind. If you're self-employed, you are not able to take advantage of this because this is usually something that is sponsored through an employer, right? So if you're self-employed, if you're married, you can take advantage of it through your spouse's plan if that's available, right? But not if you're alone and you're self-employed, you cannot use a dependent care account. This has to be done through an employer. Just keep that in mind. So let's talk about some of the stuff that you can use to deduct, right? These are things like before and after school care, right? So if you're sending your kid to private school, you cannot use the dependent care account to cover the maximum amount of $5,000. As of 2022, it's $5,000. It was actually higher in 2021. The American Rescue Plan Act raised it to $10,500 for 2021, but it's back down for 2022 as of now for $5,000 or $2,500 if you're married filing separate. So before and after school care. So if you have a child, let's say, for example, they're in school and then they have to stay after school because you're still at work, you can use the funds in this account to pay for that. Same thing if you have to drop them off early because you have to go to work, right? Also, day camp, right? So think about it this way. It's any scenario where you're actively working or looking for work. So you can't use this for like a date night. You can't use this for overnight summer camp, things like that. It has to be for allowing you to then be at work, right? So before and after school care, day camp, you can use this, let's say, physical care, like if you have an adult dependent that cannot take care of themselves, any adult daycare services from a qualified caregiver, and for a child, it could be a nanny, babysitter, so that you can work. These are all eligible expenses. Now, one thing to keep in mind is that one of the features similar to the health FSA is that it has a use it or lose it feature. So what this means is that the funds will expire if they're not used by the end of the year. So this is something very key as well. Now, I know childcare is so expensive that most people probably spend all the money they put in this anyway, but I wanted to make you aware of it because it's not something that accumulates over time. Like you have to use it by the end of a year. Now, you do have a grace period, typically 90 days, so 2.5 months or so after the end of the year to then apply for reimbursement. But in a perfect world, you would want to fund it and then reimburse yourself before the year's out, right? So that you're not stuck with losing some of that money. Very important. Also, babysitting, right? This is like the major reason which probably what it was created. But it has to be, again, when you're at work. So remember that you can't use it for date night. You cannot use it for like if you go on family vacation or if you're doing any recreational activities. It's only while you're at work and your child is being taken care of by a babysitter. All right. So this is a great opportunity, because you think about it, like, especially if you're a high earner, you want to be able to minimize your taxes as much as possible. And what better way than to put money on a pre-tax basis into this account so that you're not even paying taxes on it. And then you reimburse yourself tax-free from that account for the amount of money that you spent. All right. So the law right now says this has to be for a qualifying dependent. So that could be a child 13 years old or younger, right? So you can use it for babysitting day camp, before and after school, an au pair, nanny, things like that. There's also, if you have a disabled qualifying relative, you can use that for their daycare or day camp or any home care services as well for them. If you have a spouse that's unable to work or care for themselves, so you can use adult daycare or home care services as well. Or if you have an adult child that's unable to work or take care of themselves, same thing, right? Adult daycare, group, or home. Now, one thing to keep in mind is that you cannot double dip the benefits, because if you have children and you file taxes before, there's also a child and dependent care tax credit, right? So it's not an either or decision necessarily. So what the law says is, okay, you can use both, so you could, in fact, put pre-tax up to the $5,000 household limit into this account and reimburse yourself tax-free. And you can also use the child and dependent care tax credit when you file your taxes. So you definitely want to speak to your tax accountant about this. But the main thing is you cannot double dip the benefits. So in other words, the tax benefits received from your dependent care FSA are going to reduce the amount of the credit that you're eligible to receive, because you're not allowed to use the same expenses for both. So you definitely want to talk to your accountant to make sure that you're maximizing these benefits, right? So normally, once you have the expense, you submit it for reimbursement. The company is going to ask you for a receipt. Normally, you want to make sure that this receipt has the dependent's name, the provider's name, the date of service, the type of service, and the amount paid for the service. This is similar to you getting reimbursed from your FSA when you've had any like co-pays or any out-of-pocket expenses for medical, right? So the same concept applies here. Another thing, I have another episode where I talk more into detail about health savings accounts. So if you are in a high tax bracket and you have the ability to contribute to this dependent care account because you have children, for example, and your job also offers you a health savings account because your health insurance plan is a high deductible plan, you can do both, right? So you can put money in your health savings account, you can put money in your dependent care account, right? So why not maximize as much as you possibly can on a pre-tax basis, right? That's what it's all about. So you can get to keep as much of your hard-earned money as possible. So I'm always kind of just looking at it from that angle, because if you think about it, if you're in the 24% tax bracket, for example, and you're putting in $5,000 a year pre-tax, on the federal side, that's already a $1,200 savings right there. That's $100 a month right there that you would have normally paid in taxes, right? So this adds up between this flexible spending accounts for your health, or if you have access to a health savings account, or if you can contribute to your 401k on a pre-tax basis, like all these things really add up over time, and you can save yourself thousands of dollars on a pre-tax basis, right? And that's what it's all about. So I wanted to just briefly go over what a dependent care account is, how they work, who's eligible, all the limits. If you have any questions, as always, send me an email, luis@onmywaytowealth.com, and stay tuned for the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.